Puneet, great to have you on ET Now. Thank you so much for your time today.
Thank you. Thank you. Always a pleasure.
Well, 82% occupancy, Puneet, in what's usually your quietest quarter. Are you running a hotel company or a magic trick? That's the question today.
No, I think the demand remains very strong on the domestic front in India. And I think our asset management initiatives, marketing, strength of brand, everything is playing out together. And we hope that it stays this way. We would have preferred to have good performance also from airline catering business, but airlines are suffering and a lot of cancellations are there. But hopefully it'll be fine in the second half of the year.
The income has grown 31% this quarter and helped drive your 21% profit growth as well. Strip that out, how much of this quarter's profit story is genuinely operational versus non-core income flattering the headline number?
No, it's mostly operational. I think the operating performance has been very, very strong. Having said that, for a company that is had 125 AGMs and it's been there for 123 years. Asset management initiatives will drive in one or the other quarter non-operating income. We did not have any such one-off in this quarter, but we should expect every year certain one-offs, which is very important because of the history of the company. So I think that is key to our strategic initiatives and has been for the last 7-8 years. And I don't see that changing in the next 3 to 5 years because we have a lot of land parcels. We used to have a lot of non-core assets. But you're right, this quarter we did not have any of those activities that led to any one-offs.
I want to talk about air catering, which you only led me to, because your hotels business grew EBITDA 21% on 17% revenue growth. I mean, clear operating leverage. But air catering went the other way, with revenue up just 3% and EBITDA around 10%, plus one-off costs of about 12 odd crore rupees from Frankfurt, as well as the Noida kitchen launch. Is this particular segment, Puneet, the weakness temporary? Was it because of a geopolitical shock? Or do you think structurally more fragile business exposed to forces outside your control?
No, it is the geopolitical crisis. It's the rising fuel costs. It's the very expensive to fly planes, circumventing the region. So a lot of cancellations happened and, main premium or the margin comes in long-haul flights where there is more meal that is served. And I think this will pass after the crisis is over. This is not going to change. On the domestic front, the business on air catering stays as strong as it was. There is only an increase. No decrease on that front. And then, of course, as you rightly said, we have opened a new kitchen in Noida. It will take time for it to settle down. Frankfurt, startup costs because of delay in opening, and also the initial, ramping up of the business is going to create for us certain costs even in Q2. But our entire portfolio is robust enough to absorb these costs.
Interesting. Your FY27 guidance calls for RevPAR growth of just 7 to 9%, yet you've already delivered 14% in Q1 alone, with reportedly July trending even ahead of that. And plus, you would have a favorable base, I guess, with the BRICS Summit as well coming up. Is your guidance simply conservative, or is there a real reason you expect this space to be more than half of the rest of the year?
You're right, Aisha. The first 3 weeks of July have been very strong, and maybe we will review our guidance somewhere towards the middle or end of this second quarter. We thought on a very high base, if we deliver up to 9 or 10% RevPAR growth, it is quite strong. But the way things are going at the moment, it would be fair to say that that number could need a revision from the management side. But let's just wait for a few more weeks and then we'll get back on that, maybe first on your channel.
Yes, you must, and it's on record now. But, Puneet, Morgan Stanley pointed something out, and I must tell you about that, that your FY27 growth is guided to be more rate-led than occupancy-led. And rate-driven growth tends to be the first thing that gives in if demand softens. How confident are you that today's pricing power holds up if travel demand were to even cool modestly?
Aisha, the demand may not cool on the domestic front. I think, if anything, we could expect a very strong demand because, our three hotels in Dubai are not at the same level as it was, pre-crisis. So there is a weakness there. Because of that, West Asia is also a challenge in terms of getting our businesses up and running in a way they used to in Maldives, in Sri Lanka, connectivity to London or Cape Town, especially through Emirates Airlines flying to these destinations. So there is a weakness that has been witnessed in these markets. Also, London had not such a great start because we had a delay in our renovations by 3 to 4 months because of the supply chain disruption. But now that occupancies are coming back in Dubai, the rate will follow a year later. We do expect the rates to stay solid. And as you said, the BRIC summit and the second half of the year with very strong wedding dates should help us improve the rate positioning of our portfolio. And with the strength of our brand, especially driven by now Ginger also. Taj has always been the strongest. Now Ginger is also helping drive growth. That we should be able to maintain or deliver a bit more than what we have guided for.
So, you've put roughly 60% of your FY26 capex into renovating existing properties, right? Rather than adding new keys. And it's clearly working, I guess. Taj Palace, Taj Fort Aguada, they've all delivered very good room revenue growth. At what point does the return on a refurbishing of a marquee asset start to taper down? And how do you decide which property gets the next big renovation budget?
It's a function of occupancy. High occupancy driven hotels need a refurb in 5 years. Lower occupancy, or like let's say if you're in 60s and 70s, then you may need 7 years to do a refurb. And in order to maintain your iconic status, you have to invest in your assets. This is the opportunity of driving operating leverage, but at the same time also a challenge in bad times because operating leverage is not there and the renovation is still needed. So I think what we have been able to do is to change the mix from 70% asset heavy to only 30% asset heavy today, coupled with the fee-based growth, which has been very strong. We are expecting to open 60 hotels this year, which means more than a hotel a week. And if 90% of those are coming on an asset-light basis, then we are very well positioned to keep driving both operating leverage as well as fee-based growth, which help you to deliver good margins.
So you're sitting on a very handsome net cash position, right, of over 40 billion rupees in an industry where balance sheet flexibility is often the real difference between opportunistic growth and forced caution. What specifically are you holding that powder dry for?
For any good opportunity that might come, but also to have a strategic cash reserve for any time that unforeseen challenges come your way, like the pandemic came our way, like the wars come your way. We don't want to get back into a debt spiral, but definitely a cash reserve equivalent to like half of the cash that we have should suffice. But the other half could be deployed for any kind of strategic initiatives, capex, and we want to spend a lot of money, Aisha. You know that we've spoken on your channel about the Taj Bandstand, which is the next iconic asset, India's equivalent of Marina Bay Sands or Burj Al Arab. So I think there is a lot of investment being made, including in our palace, in Pushpabanta Palace in Agartala, the first palace property in the Northeast, and many others, Taj in Ranchi, which we are doing with our own money. The two islands in Lakshadweep were now finished the design, so construction should commence. So there is a lot of investment happening, but all that investment will be very strategic, driven mainly by also capital subsidies, states that give capital subsidies, make those investments attractive. We'll go for that. Otherwise, I think we are also very pleased with the increase, exponential increase that we have had in our management fee business. It's grown by over 300% in last 4 years. So, and in this quarter by 26%. So I think as long as it keeps working on both these pillars, we are very pleased with that. And also the new acquisitions we did last year are also getting well integrated, and I think they will also start contributing significantly in the quarters to come.
So on your management fee income, the fact that you've already guided to keep growing it at a higher teen CAGR, comfortably outpacing the room revenue as well, as that mix keeps shifting, does IHCL start to look and get valued less like a hotel owner and more like a branded licensing business? I mean, is that a transition that you're deliberately sort of steering towards?
Absolutely, and we started on that journey 8 years ago. And I think it's not just, I think the hospitality sector is seeing a structural change from being just discretionary to being a part and parcel of everybody's life, because the new India has the ability to go and, spend time, whether on leisure or on business, tier two, tier three cities, metros, concerts, sports events, summits, business delegations coming. So a lot of that has something to do with the new India of the last 7, 8 years that we're seeing, which has driven the cyclicality factor to a lower importance than has been the case in the preceding decades that we have had behind us.